Hi guys and welcome. On this video, we're going to review some of the great tips for beginner investors. What are the things to pay attention to? How to define your risk tolerance? Why you think long term, and what's the most important investment you should? Let's start. There is a natural tendency for people to put off investing or totally stay away from it just because of fear. There are a lot of things a prospective investor might worry about. You might not be able to buy the right instrument and end up with the wrong investment. You might miss the right timing and not be able to buy or sell when you should. And there's also the worry that the economy might take a downturn and cause your investment to crash to the ground. They are valid concerns, but they should not stop you from making your money work for you. Investing could be simple and not complicated, but it is important to start early and stay disciplined. Saving and investing early in your life is wonderful because the longer you can use compound interest to work to your advantage, the better returns you will get. Let's make it clear. We are not giving you advice or tips on how to improve your investment strategies. These simple tips are for beginners who would like to get on board but are apprehensive to start their investing journey. So, to help the fence sitters or those who are clueless where and how to start, here are a few things to remember. Understand which type of investor you are. Are you comfortable taking risks? Do you see yourself able to actively participate in the market several times each day? If so, you could adopt an active investing style. Active investing means you focus more on the present-day scenario rather than the long-term horizon. Active investors keep an eye out for certain specific stocks and use good market timing to try to outperform the market to gain short-term profits. It requires an investor to constantly monitor the market and his position in the market. If you're a passive investor, you know you're there for the long haul. Passive investors minimize the amount of buying and selling within their portfolios, ensuring cost-effectiveness in their method of investing. This practice is basically a buy and hold strategy. It often requires resisting the urge to react or anticipate the stock market's constant movements. The best example of a passive approach is by investing in an index fund that follows one of the major indices in the industry, such as the S&P 500 or Dow Jones. Basically, you'll be owning tiny portions of thousands of different stocks, and you earn your returns as a participant when the corporate profits of these stocks go up over time in the overall stock market. Successful passive investors are the ones who have learned to fix their gaze on the prize at the end of the course and ignore short-term losses and sharp downturns. Get into it as early as possible. Sometimes, when you see the value of certain stocks reach unimaginable heights, you wish that you have bought even one share so you can participate in the elation of winning. Or maybe you have friends who tried their luck with Bitcoin and enjoyed a crazy windfall after a few months. The temptation can be more intense the more that you hear about these instant millionaire stories. There's no denying that. But you should remember that before these people got their rewards, they took risks. And when you're a newbie, it's not a good idea to go all in. Hindsight is totally different from foresight, although many people mix them up. Do you find ETFs and index funds boring? They could be. But experience tells us that they are likely to outperform the market. If you're debating with yourself daily whether to buy or sell with a small amount of money, you won't get anywhere. As we've said, looking at the boring stocks is like watching the grass grow. They normally move in just one direction, but very slowly. However, the exponential power of compounding interest is what will blow you away. Look at the following illustration. If you have $5,000 now and invest it in an index fund that grows 60% per annum, you'll end up with $50,000 in 40 years. Chalk up another argument for the adage that says time is money. In investing, every year that you lose in the market can substantially lessen your return in the future. This is why those who invest early have no trouble retiring early. Those who invest later may have to work longer before they can comfortably transition to retirement. Set long-term goals. Before you even start scouting for investment opportunities, you have to assess your present situation and look forward to where you want to go down the road. If you think you can't be in the market for the long haul, then don't even bother getting started. The real value in investments come in the long term, so forget about those get-rich-quick investment schemes. Here are the questions to ask yourself. Where do I want to be financially in the next 5 years? The next 20 years? How much do I have now that I can invest? How much do I expect to earn over time? How long should I keep on investing? What do I expect as contributions over time? Which investment options are ideal to start with that fit both my long-term goals and my current finances? Once I'm in gear, what adjustments should I make over time so that I can stay on track towards my goals? A major benefit of investing is how it systematically sets up your money to grow it efficiently until you reach your goals. For example, you may desire to retire at 60 or buy a new home within the next 10 years, or just spend a year off from work to take a world tour. Whatever it is, you'll want to time your investments so that their fulfillment coincides with the time that you'll need access to your money. Evaluate your risk tolerance. Risk tolerance basically refers to how much variability you are willing to bear when it comes to your investments. Genes primarily determine your tolerance level, but education, income, and wealth positively influence it as time goes by. As they increase, it appears that your tolerance level also increases. On the other hand, your risk tolerance goes down as you age. Your risk tolerance summarizes how you feel about risk and shows you the degree of worry you feel when you perceive that risk is present on your investments. When you understand your risk tolerance, you can steer clear of investments that are likely to make you nervous. A good rule to follow is never to put your money in an asset that would make you lose sleep. Worry often leads to fear and can trigger emotional impulses instead of logical responses to the situation. In times of financial uncertainty, the investor who can remain calm and follow the analytical decision-making process ultimately has more success. Investing is not trading. You have to set your sights on transforming yourself to become a true blue investor, so don't panic if your stocks are correcting and prices are going down. Look at it as an opportunity to bring in more shares to your portfolio. You need the patience to be an investor. It is always probable to go through tough times of recession. Impatient investors make bad decisions and lose money. Patient investors wait and collect dividends. Patient investors bide their time until a good moment to add more stocks to their portfolio and later get higher ROI. Both investing and trading follow the same golden rule of money management. To make more money, you need to reinvest your profits. Learn how to control your emotions. Some investors fail because of their inability to make logical decisions, because they get carried away by their emotions. You could probably say that the current prices of assets is a reflection of the collective emotions of the investment community participants. When the majority of investors worry about an asset, they tend to bring down its price. When the majority feel positive about the company's future, the price usually goes up. So, it's normal for investors to feel some anxiety and insecurity when asset prices do not move according to their expectations. If that happened to you, you'd probably be asking yourself these questions. Should I sell my position and minimize my losses? Should I hold on to it and hope that the price will rebound? Will it be okay if I buy more? But observe that even when things are going as you hope them to, you still ask some questions. Should I take this opportunity now before the price goes down? Should I stay because the prices will go higher? These thoughts may flood your mind, especially if you're always watching the price of a security. Eventually, you'll reach a point where the urge becomes so strong that it will force you to take action. And since your decision depended primarily on how you feel, the probability of making a mistake is very high. Remember that when you buy a certain asset, you should already settle the question of why you are buying that particular asset and not another. Therefore, you should have an expectation of what the price will do, if your reason is valid. At the same time, you should already make up your mind when to liquidate your holdings, especially if your reason proves to be false or if the asset does not react as you have projected. In short, have an exit strategy ready beforehand. Then, when the time comes, execute that strategy no matter how you feel. Keep investing in yourself. You've read all the way here, so it shows you're off to a good start. Remember that there's plenty of information out there, and this relevant information is valuable. Never say that you're too old to learn something new. You might need to filter the sources for your investing news in financial markets. Choose the ones from credible sources or those that are not afraid to recommend what's the best for you. You have access to the internet at any time and all the time. A single click could open millions of investment guides and tools for your benefit. Keep in mind that investing in yourself will also reap dividends, but it may cover many different areas. Maybe it's your knowledge of the stock market that's developing, or perhaps you're learning from the experiences of other great investors who have walked the beaten path. You might also be investing in yourself by becoming more mature and level-headed in your decision-making. The big idea is to keep yourself growing by learning things. make sure to diversify. One great way to protect yourself against the unpredictability of the market is to see to it that you have money in more than just one type of investment. Assemble a portfolio made up of bonds as well as stocks, and a mix of stocks in small and big companies in the U.S. and other countries. The fastest way to set up a mix of investments is by buying a mutual fund with a diverse portfolio. It lets you own a small portion of many stocks and/or bonds altogether. Diversify with asset types. Create a mix of assets like stocks, corporate bonds, government bonds, real estate, gold shares, and more. Diversify with sectors. Spread your investments to cover different sectors so that if one sector takes a big hit, the other sectors can stand. If all your assets are in real estate and real estate companies, a slump in the real estate market can considerably cripple you financially. Diversify with geography. Get assets from all over the place. If you own a mix of stocks, bonds, real estate, and other assets, but they are all based in Japan, what would happen to your investment when the Japanese economy takes a downturn? Your investments will do the same. You can consult a financial planner to arrive at the right asset allocation for you. A professional would be able to do this by taking into account your age, goals, and risk tolerance. Or you may DIY by using an online calculator, like the one from Vanguard, to get a good picture. If you're more of a hands-off type, you may try a target date fund. It will automatically allocate your investments and make the necessary adjustments according to your timeline. That's it for now. On our website, you can find more posts, as well as calculators and other financial tools. What's your best tip for beginners? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial educative videos.